Thanks for joining us today on Market Call. I'm Marella Fernandez. Andrew Moffs on the show with us today. He's Senior Vice President and Portfolio Manager at Vision Capital. He'll take your questions on real estate stocks. Here's how to reach us. 1-855-326-6266. If you want to call in, you can also email your questions. marketcall@bnnbloomberg.ca. Andrew, thanks for joining us today.
Thanks for having me.
So REITs didn't do very well at the start of the year. I'm wondering, with investors now rotating out of tech, have they picked up?
They are beginning to. They're beginning to percolate. I mean, if you look back at the past 5 years in the U.S., REITs have done about half the performance of the broader market. In Canada, it's even worse, about a fifth. And we think it's completely unwarranted. This is one of those times, truly, where we think there's a great opportunity in the public markets in real estate, where the stocks are trading at wide discounts to net asset value, but more importantly, where the fundamentals are pretty good. I mean, you look at the earnings of REITs, we saw 7% earnings growth, bottom line, for U.S. REITs in the third quarter. You look at the supply side, and we're seeing falling supply after 3 years of high inflation, crackdown on immigration, construction is really way down. So you have all the perfect backdrop, and then you throw in stabilizing interest rates. We think the market is going to start looking closer at real assets where you have somewhat of a hedge to inflation, where replacement costs have gone higher, where the values are disconnected. And, I've seen this movie before. If you think back 25 years ago after the tech wreck, there was a big opportunity for M&A. And we think that can happen here with lots of capital sitting on the sidelines, hoping to take advantage of what we see as a big disconnect between the private market value, the net asset value of these companies, and the publicly traded prices.
Okay. Do you expect industrial REITs to do better than, for example, apartment REITs? Have you sort of sussed that out yet?
Absolutely. I mean, what's great about our sector is that there's a lot of dispersion, and it makes a lot of sense. You have different supply-demand fundamentals by geography, by property type. So to your question, we think industrial is at a very sweet spot sitting here today. GDP growth is positive. We're seeing global trade starting to reorient. What does that mean? You're starting to see nearshoring, onshoring, the return of manufacturing to North America. All that activity means that warehouse activity needs to pick up, and there'll be further demand. You mentioned apartments, residential. We still think there's a bit of a supply problem in North America. Too much construction happened, and all that needs to be absorbed at a time where the job market isn't as strong as it once was. So at Vision, what do? We do a top-down exercise, just like you asked, and we go through the different geographies and property types, and industrial is one that we like. Grocery-anchored shopping centers is a favored one. Seniors housing are all asset classes that we think are defensive and have growth today.
Okay, let's take a quick break. We'll line up our first phone calls and emails for when we come back. Andrew Moffs of Vision Capital here with us today, taking your questions on real estate stocks. We're back in just a moment. Welcome back. Let's go straight to the phone lines. Mike is on the line in Toronto. He's got a question for Andrew today. Hi, Mike.
Hi, I'd like to ask about Storage Vault. It's just kind of meandered sideways for a while some other REITs have kind of bounced. What do you think about it here? Okay,
thank you for the question. Andrew, how is storage doing these days?
So the self-storage industry, the demand side is typically predicated on activity, housing activity specifically. Of course, it's a very resistant business, recession resistant, because it does benefit by things that happen irrespective of what's happening in the economy, death, divorce, dislocation, disaster. But it's housing activity today where we're not seeing enough home sales or population migration, especially here in Canada, where we've seen a curtailment in population growth. And as a result, self-storage activity has come way down from what it was. And by translating it to the actual company, street rates are much lower, the amount of rent that they're asking. Storage Vault, the stock itself, has actually done well amidst this backdrop. It's been a tougher what was a great backdrop through the pandemic. It's been a tougher backdrop for them most recently. We think the company's navigating well throughout it. but it is in a bit of a holding pattern, like the caller alluded to. I think you want to see a pickup in home sales to a far greater extent. We've started to see that turn, not housing prices, but sales. We've seen the volume pick up, but we want to see it increase to a greater degree in order to really get behind the self-storage industry.
Interesting, because I always think that it's not necessarily homeowners who are looking for the storage, but people who rent and moving apartment to apartment and are using that for sort of overflow stuff. But you're saying just as crucial is those who own private homes.
Absolutely. Whether it's renting or owning private homes, one of the dynamics we've seen, for example, in the Greater Toronto area is with the high cost of housing, particularly on the rental side, people are not moving. So where we're used to higher turnover of apartments, it's now single digit. And so that, again, when people move, they also go from a bigger apartment to a smaller apartment or vice versa, or they're going across the country. They need to store stuff in self-storage facilities, and that's just not happening to the same degree that it once was.
Okay, let's go to an email question then from Lori. Lori says, what are your thoughts on Granite REIT, GRT.UN on the TSX? They do, so I know they're global and they do sort of development, acquisition, construction, a little bit of everything. What's your take on Granite?
So Granite's a very good company operating in the industrial warehouse space. They own facilities in Canada, in the United States, and in Europe. Their largest tenant is Magna on the automotive side. They own special purpose facilities where Magna manufactures car parts for the OEMs. As a result, they have a very solid cash flow, good tenant base. Where we have seen some pressure on Granite's performance has been in some vacancy in the United States. They own good facilities. They're in more Midwestern markets where there has been a lot of new supply, and Granite has done a good job working through some of the vacancy. The stock has responded as they've leased up some of that vacant space. And we think sitting at these levels, it's somewhat fairly valued. And though we love the space, we love the industrial warehouse space, we do see some bigger discounts elsewhere where we prefer to be invested.
Okay. Let's move on to another email. This one is from Tony. Tony says, what is Andrew's opinion and outlook on healthcare property REITs operating in North America? And should an investor focus more on Canada or the U.S.? Healthcare REITs, can you talk about the difference between both Canada and the U.S. in this sector? Just because we have covered healthcare here, they don't have it there. So how does this shake down into the REIT sector?
Yeah, and so I talk about how there's over 16 different property types within real estate, and if you went within healthcare itself, you'd find many. Within healthcare, you can look at either retirement, where it's 100% private pay, and that works on both sides of the border, or you can look at what we call the long-term care segment here in Canada, the nursing home segment in the United States, where there's a government funding element to it. That's ignoring other types of properties, whether it's medical office, life science, but let's focus on government-funded nursing homes and long-term care in Canada. That's a sector that we really like. You're really taking, for example, in Ontario, you're taking on government credit, the Ontario government credit, where there's over 35,000 people waiting to get into long-term care facilities, and the government is paying their rent effectively, and the operators simply have to manage a margin, and we think they do a great job. In the United States, there's more of a stroke of the pen risk between funding of these beds, whether it's from Medicare on the federal level or Medicaid at the state level. And a lot of states are seeing a lot of pressure in terms of their tax-based revenues. And it's a sector we're trying to avoid. And since we are a long-short fund, we do short stocks within the healthcare REIT sector in the U.S. So to answer the caller's question, we are much more focused on Canada today. On the healthcare side, we see greater valuation as well as a much better defensive cash flow characteristic.
Okay. And I know we'll talk a little bit more about that later in the show. Okay, let's go to Chris on the line. He's in Delta, BC. Hi, Chris.
Oh, good morning, Marella. Welcome back. I would love to have Andrew's opinion on CapREIT. It's not a full position in my portfolio, but over the last few years, I've heard quite a few analysts speak about it as kind of a bellwether blue chip landlord of Canada, the largest publicly traded, and so I have been building it up to a position. The stock has not performed well, and so I'm wondering if you still see this as a good long-term investment for a 29-year-old investor, or if you'd be looking somewhere else. Thank you very much. I'll hang up and listen.
Okay, thank you for the question. CapREIT at 38.10 today. What are your thoughts about CapREIT?
Yeah, so all the attributes that the caller gave towards CapREIT are valid. It is a bellwether. It's one of Canada's largest landlords, and those are all positive things. What didn't come up were the sector's fundamentals. The multifamily market across Canada right now is in a tougher position than it was a few years ago. We've seen immigration levels come off. We've seen a lot of new supply. And as a result, if you look in the greater Toronto area, if you look at two-bedroom rents, the rentals.ca data came out for October, and it was down 7.4%, the asking rents. You layer on higher incentives than what we've seen. I mean, many years ago, the idea of offering incentives on apartments was really out of the question. Today, we're way ahead of where normalized incentives have been and should be. At the same time, there's been a big condo market headwind in terms of new supply coming to the market. So all that means is that it really has not been a landlord's market by and large in some of the key markets in Canada. We are way more focused on markets where there are no rent controls and where there's population growth. So think Alberta, Saskatchewan. CapREIT is more focused in the Ontario market, and as a result, are not able to push through the rent growth that we can see in other companies. I think management is doing a great job navigating through this tougher market. They are doing a great job on capital allocation. We're seeing them actively buy back their stock and recycling assets, but for the moment, it's not a sector we're looking to invest in, but for select opportunities.
Okay. Let's take a quick break. We will have Andrew Moffs with us at Vision Capital taking your questions today on real estate stocks. We'll line up more of your phone calls and your emails for when we come back. Stay tuned. Welcome back, and thanks for joining us. Let's go right back to the phone lines. We have Glenn on the line. He's in Toronto, and he's got a question today for Andrew Moffs. Hi, Glenn.
Hello. Thank you for taking my call today. I would like to know about America Cold Storage. I want to know why it's down, and would it be a good time to buy for a 5-year hold? Thank you very much.
Okay, thank you for the question. So they do the temperature controlled, I guess, are they distribution centers for grocery, that kind of thing?
That's right. They are a key component of the infrastructure, backbone of the food supply in the United States and globally. Americold is the company, the ticker is COLD. This is the refrigerated warehouse business where we do think there is a moat in the business. Typically, only certain food companies want to deal with certain landlords, and Americold is one of the premier operators. As you can see, the stock has really suffered over the past year. This was a pandemic darling, and since the pandemic, they've had to navigate a much tougher environment. People are not eating less. What's different today, because of food inflation, people are buying less in the grocery store. So think your basket size has gone down, there's less waste, and perhaps people are shifting away from fresh food to more pantry style items. And so they're seeing demand fall, and that's also what I haven't talked about is layering on the effects of Ozempic, et cetera. And then on the supply side, we've seen a lot of new supply, not necessarily in their markets, but it's enough to get the market worried. So the combination of the two has meant a loss of pricing power and occupancy levels down to levels we hadn't seen in a very long time. And the stock has had to navigate through this operating backdrop and at a time where management has changed. So looking prospectively, we think the stock is near a bottom. It looks pretty cheap. It's certainly on a net asset value basis, the private market value of its real estate. So for a long-term investor, it does come with risk. There is a lot of upside here. It's very difficult to call the trough in terms of where these fundamentals seem to go to.
Okay. I hope that was informative for Glenn as we move on to Mike, who's in Georgetown, Ontario, with a question. Hi, Mike.
Hi, Andrew. I'd like to get your opinion on Crombie Real Estate Investment Trust. It yields 5.9%. The yield's been pretty flat for the last 4 years. I just wanted to get your opinion on that company and its what its main tenants are and what you think of it going forward. Thank you.
Okay, thank you for the question. We'll pull up the line chart for Crombie REIT. What do they run? What do they oversee?
So they own grocery-anchored shopping centers across Canada. Their primary tenant is Empire, which owns the Sobeys brand. And Sobeys Empire continues to be a large unit holder of the REIT. We think very highly of this company. We are shareholders. What I like about the portfolio, and again, grocery-anchored shopping centers are necessity-based. They're recession-resistant. This is an asset class we really like, operating near record occupancy levels here in Canada today with very little new supply. Crombie, notwithstanding, some of the pushback on the company is that they might own secondary centers, own centers in secondary markets. I think in the Maritimes and Nova Scotia, et cetera. They're able to generate very compelling internal growth rates, whereas some of their peers do not. And so we think this is a neat little company that trades at a discount to net asset value, has a very compelling distribution yield that the caller mentioned, and has a very compelling internal growth, and they're layering on some effective development and redevelopment across the country, both from Vancouver all the way out to Halifax.
Okay, I have a 5.85 yield. Does that sound right? I thought the caller had said something different.
Yeah, no, that sounds right.
That sounds right. Okay. Okay, so I hope that's good for Mike. Let's go to John in Hamilton, Ontario. John, what's your question today?
Hi, thanks for taking my call. I'm looking at a comparison between CT Real Estate and Smart Centers. I own both. Would be interested in hearing your take as it relates to future growth potential. They both pay great dividends. I'm recently retired. I like that income, but I'm also looking at inflation down the road. And do you have a preference towards one or the other, or even keeping both just for growth purposes? I would be interested in hearing your opinion. Thank you.
Thank you for the question. Is CT a healthcare REIT?
No, CT REIT is the REIT that owns Canadian Tire's assets.
Got it. Thank you.
So both, so Canadian Tire REIT and then Smart Centers REIT is the REIT that is an owner and manager of Walmart-anchored retail centers with a large development portfolio. So both, by the nature of their tenant base, are very stable. In fact, both have very low internal growth rates because of that stability. So you're trading off one versus the other. I think in the third quarter, you saw something like 2.6% same property net operating income growth for Smart Centers, which is okay, which is good. But we look for, if the caller's looking for growth, you're not really going to find it in either. You will see the stability in the distribution. I think it's over 7% for Smart Centers. Canadian Tire REIT is something less than that, but they're going to be very stable. But I wouldn't be looking for much else in terms of your total return beyond that. If you have 1 or 2% growth above that, that is great. I think in Canadian Tire REIT's case, it's a 5.8% yield. There's other opportunities in the retail sector that we can talk about later in the show if you're looking for growth. But if you own either, if you're looking to pick one over the other, certainly the stability of CT REIT's distribution is not in question. Some are questioning the stability of Smart Center REITs, just given that their payout ratio now hovers around 100%.
Okay, good to know. Let's move on to another caller. Gordon is on the line. He's in Victoria, BC. Hi, Gordon.
Good morning. Automotive Properties REIT. I like the business model. I like the properties. I'm concerned about governance. The Delawi family is the controlling shareholder. They vended the initial properties. They continue to vend properties. And I just think in general with independent directors, quite often if you dig a little bit, you find indicators that they might not be quite so independent. You see a lot of connections with fellow directors and so forth. And my concern would be if the Delawis attempted to take the REIT private at some point, what would be the attitude of the independent directors? What are your thoughts?
Okay, thank you for that question. How well do you know automotive properties, Andrew?
I mean, well enough to agree with some of those concerns. The Dilawri Group, I think, represent about 48% of net operating income for automotive properties REIT. That's a big concentration in one tenant. Forget about the sector. We generally try to avoid large concentrations with one tenant because you never want to wake up that day where there's an issue with that tenant. Secondly, that same group is the largest unit holder. They own 31% of the REIT. So by all intents and purposes, they do control the REIT. Again, we look for independence when we invest in the names that we own. Not to say it's a bad investment, but those are just two things to be cognizant of. If you own this REIT, you're really attracted to the high distribution yield over 7%. What I would say in terms of operations, this is actually the first year where they've been effective in terms of diversifying away from this large tenant and pursuing third-party acquisitions of other automotive dealerships across North America. So that is a positive, and hopefully that translates to better earnings growth because hopefully they're doing this in an accretive manner. They, at a high level, operate in what we call the net lease space, where you have long-term leases to high credit tenants. So in this case, not a sector that we're invested in today. We're looking for more growth, just given the compelling discounts that are out there in the market.
Is it a competitive space?
From a publicly traded standpoint, there are no other public competitors. There used to be a handful. They are typically what you'd find is more on the private equity side, that there is a very vibrant market in the United States where there's what we call 1031 capital, where people are able to sell properties and defer taxes through 1031 exchange by buying another property within a certain amount of time. And you find auto dealerships fall within that category.
Okay, let's take another quick break. We'll have a look at Andrew's past picks when we come back. Stay tuned. Time now to take a look at Andrew's past picks. These are from January 30th of this year, so just almost a year ago. First Capital REIT was your pick at the time, Andrew, FCR-U on the TSX. It was $16.74 at the time, now up to $19.58. 17% upside, a total return of 21%. So they are one of the grocery-anchored sort of mixed-use real estate properties here. Do you still like this REIT? Have you held on to it?
Still like it, have held on to it. I'd say this is the highest quality urban portfolio with necessity-based tenants across Canada. This is what we mean by looking for higher growth and defensive at the same time. We think First Capital REIT has the best portfolio across North America of grocery-anchored shopping centers. Notwithstanding the great move it's had year to date, we think there's a lot more to go. We think it's worth 22.5. That implies 13-14% discount to that value. That's our net asset value estimate. And why do we feel so strongly? They're operating at near high record occupancy levels, over 97%. They're seeing double-digit rent renewals. So when that tenant comes up for expiry, they're able to charge them double-digit increases. And all that's translating to internal growth rates over 5%. And so you're able to own something at a big discount to net asset value, get paid while you wait with a healthy 4.6% distribution yield. And so this continues to be a core position in our fund.
What falls under mixed-use real estate? Is it primarily other retail?
Mixed use can be a combination of owning retail and office or residential all in one sort of development. And it can take on many different flavors. Okay.
Let's get to your next past pick, which is Dream Industrial REIT, DIR-U on the TSX. At the time that you picked it, which was right at the end of January, it was $11.97, now to $12.37. So 3% upside, 8% total return. And they do industrial properties. And I'm wondering where they hold those properties and what the industrial scene is like these days.
Yeah, so they hold these properties in Canada, Toronto and Montreal, as well as out west, and then in Europe, primarily in Germany and the Netherlands. And then they operate partnerships in the United States, as well as a privatized Summit Industrial REIT with the government of Singapore Sovereign Wealth Fund. And so they own a high quality portfolio across Canada through that venture. We think they own high quality properties. Their properties are typically what we call smaller bay, meaning they're not those large distribution facilities that have gone overbuilt across North America. These are the smaller types of facilities that are in key gateway markets. They are smaller, they're closer to the urban centers, so they are typically that last mile delivery that is so crucial to all of us when we expect our Amazon deliveries to arrive the next day. We think it's rare to find such a high quality of a platform, such a compelling growth story, trading at such a wide discount to net asset value. And you find that in Dream Industrial REIT. It's got a 5.7% dividend yield. It's probably worth $16.50. That's about a 26% discount to net asset value. So notwithstanding the move we've already seen so far this year, we think there's a long way to go. We think their industrial fundamentals are pretty compelling sitting here today.
Would Amazon be one of their customers?
Yes. Typically what you find across all the industrial landlords are those third-party logistics companies as well that help fulfill all the packages that we get. Okay.
Let's get to your third past pick then. Sienna Senior Living, SIA, on the TSX. This was 1584, now to 2092, 32% upside, 37% total return upside. And we talked a little bit about this at the top of the show. This is a growing market just because there isn't enough supply. Did you like about Sienna Senior when you chose it at the start of the year, and is it something you've held on to?
Yeah, so what did we like about it? Sienna operates in two segments, that long-term care segment that I talked about, as well as the retirement home sector. So about half and half for their business. Why did we like it? There's been an ongoing recovery of retirement fundamentals. And what we loved about the stock when we came out of the third quarter was that at the beginning of the year, they had hoped that they'd get to 95% occupancy rates in the retirement sector next year. By the third quarter, when they announced results, they said, we'll hit that target by this year. What does that mean? We're at levels we've really never seen on average across the retirement sector in Canada. That is very compelling because margins typically expand once you get over 90%, and those dollars really drop to the bottom line. So the catalyst for the stock remain the ongoing recovery. It's the redevelopment of those Class B and Class C long-term care homes that they have and acquisitions. We see upside to their outlook. 2026 will be another great year where same property NOI growth will continue to go higher. Margins will continue to expand. And you're really enjoying one of the best fundamentals in any real estate asset class in many years. And we think it will continue for Sienna.
All right, good to know. That was Sienna Senior Living SIA on the TSX. We're going to take a quick break, lining up more of your phone calls for Andrew Moffs of Vision Capital, taking your questions on real estate stocks. Back in a moment. Welcome back. Let's go to the phone lines. Dave's in the line. He's in Celesta, BC, with a question today. Hi, Dave.
Hi. Thanks for taking my call. I was calling regarding Slate Groceries. It's on the TSX, but they own the mid-size U.S. grocery stores. They pay an 8% dividend, but they pay the dividend in U.S. funds, so it's probably over 10%. It's very low volume, but I've had it for over a year now, and it's done quite well. I was wondering if you owned it, and what do you think about it for the future?
Okay, thank you for the question, Dave. Let's go to Andrew on Slate Groceries. What kind of grocery stores would they own? What's mid-level in the U.S. these days?
They own smaller grocery-anchored shopping centers in more secondary markets in the U.S. Sunbelt. So we like the strategy. We like, as you've heard, we like grocery-anchored shopping centers. Focusing on the U.S. Sunbelt is a positive because we see a lot of people moving down south to low-tax states and no-tax states. What we don't like about the enterprise, about Slate Grocery, notwithstanding it's an attractive distribution yield, it's not covered by earnings. So we think that their distribution level is too high. It's not sustainable. And where they are suffering from an earnings headwind is from their high debt levels. They have low-cost debt that's been rolling over to high-cost debt, and they have too much of it. So they, on the operations side, they're doing well. They're seeing some healthy renewal rates like we would expect on the tenant side. But it's really the balance sheet that's been an issue for this REIT, and hence not a name that we're looking to be invested in today. If you're looking to invest US dollars and you're looking to invest in grocery-anchored shopping centers, I'd highly recommend looking at a company called InvenTrust, ticker's IVT on the New York Stock Exchange. You're going to get a better quality portfolio, better balance sheet, and sustainable dividend, and you will be effectively in the same asset class.
Okay, Slate Grocery, so that dividend yield is 7.98 is what they're looking at. Okay, let's go to Ken. Yeah. Ken's in Kitchener, Kitchener. Is he Kitchener, Ontario? I'm not sure. Ken, what's your question today?
My question today is the Northwest Healthcare Property REIT. The last time it reported, it did quite well. It's got a nice dividend of about 6.5%, and it had a little bit of a pop when it reported, but it sort of settled back down. And I'm just wondering where you see it going from here. Thank you.
Thank you for the question. Northwest Healthcare, we'll pull that up in just a second. Can you tell me a little bit more about it?
Yeah, so there's a lot of enthusiasm behind the stock as it's a turnaround story. It owns medical facilities in Canada, in the U.S., and then globally in Brazil, UK, and Australia and New Zealand. This is an enterprise that has grown a lot over the past decade. It grew too far, too fast, and with too much leverage. And the stock has re-rated considerably through distribution cuts, change in management, change in the board. There is a new executive team put in place. That's what I meant by the enthusiasm. It is now a show me story. Can they effectively sell out of their interests in Australia, New Zealand, Europe, Brazil, and refocus the portfolio to what they used to do best, which is operate medical facilities, hospitals, and medical office buildings across Canada and into the United States. And so you're going to see a lot of churn in this company, selling assets, buying assets. Not sure what it'll all mean for the distribution or the earnings trajectory, but at least the enterprise has stabilized after some very choppy, after a very choppy couple of years. So it's like I said, show me story. If you're looking for something higher on the risk tolerance spectrum in real estate, this would definitely fit in that category.
Okay, we thank Ken for the question. Let's move on to Kevin in Toronto with his question. Hi, Kevin.
Hi there. Thanks for taking my call. My question is on Dream Unlimited. It was around in July. It was around $22, and it's dropped down a bit from that. Do you think this is a good entry point, or should I avoid it? Thank you very much.
Okay, thank you for the question. Dream is different from Dream Industrial, Andrew?
This is the caller is asking about Dream Unlimited. The ticker is DRM. Dream Unlimited is the external external asset manager of Dream Industrial REIT.
Okay.
And so this enterprise is an asset manager, as well as on its balance sheet, it owns communities in Alberta and Saskatchewan. They basically in the land business, where then they develop the land and create communities and recycle the capital. And then not just for housing, they take that capital and build purpose-built rental, retail, et cetera, on their land. They also own a land portfolio in the Greater Toronto area, where they've done some great developments in terms of going vertical on condos, same thing in Ottawa, et cetera. So it's a bit of a complicated enterprise. It's not a REIT, it's a corp. It's got two distinct businesses, asset management, where they externally manage publicly traded companies as well as funds, as well as this land business that I talked about. As a result, it always perennially trades at a wide discount to net asset value. It's in a tougher position today because of the land business, specifically on the condo side, is just a very impaired business. That said, we think it's a pretty good store of value. It's certainly attractive from a long-term perspective. Michael Cooper is the majority owner of that entity, and he has been pretty adept at capital allocation. Right now, we're focused on some of the entities that they control, and like I mentioned before, Dream Industrial we think is probably the most compelling within it.
Okay, let's get you a quick email then before we take a break. Glenn wrote in, and he's in Winnipeg. He says, I'm wondering what Andrew thinks of Mainstreet Equity. I've seen guests speak favorably about it, but it has such low trading volume that has caused me to avoid it. And that, again, is a question about Mainstreet Equity. We'll pull that chart up in just a second. Andrew, what are your thoughts?
I think highly of this company. Mainstreet Equity owns apartments in select markets in Canada. Their concentrations in Edmonton and Calgary, in Abbotsford, British Columbia, and Surrey, as well as in Saskatoon and Regina. These are all markets that have benefited primarily from non-rent control, as well as compelling demographics, compelling population growth, and interprovincial migration. What I really like about this entity, because it's not a REIT, they are able to grow effectively without having to raise dilutive equity and not have to pay out their cash flow to unit holders. We trust them with our capital. They're great at reinvesting our capital into their properties as well as into further acquisitions in their markets. The stock chart really is proof in the pudding in terms of their ability to execute. I appreciate the illiquidity of this stock, and hence any opportunity that arises where there is a pullback in the stock, we think is a great entry point. This is a long-term compounder. This is what you'd like to see in every real estate entity, where they can create the value for you as opposed to constantly having to pay you back in cash flow. We all like the cash flow, but we are total return investors.
Okay, that was from Mainstreet Equity. Let's take a quick break. More of your questions for Andrew Moffs of Vision Capital when we come back. Stay tuned. Welcome back. Let's go to Richard on the line in Ottawa with a question today for Andrew. Hi, Richard.
Hi, Morel and Andrew. I'm wondering about Nexus REIT. I've owned it for about 4 years now, and I'm wondering if there's more growth ahead.
Okay, thank you for the question. We'll pull up Nexus and have a look at that. Andrew, tell me about Nexus.
Yeah, so Nexus owns industrial properties primarily in markets in Ontario, Quebec, Saskatchewan, and Alberta, around 10 million square feet. It's a smaller market cap company, about 550 million. People typically own it for the attractive distribution yield over 8%. The growth rates have not been as compelling as other investments in the industrial space, hence we focus on names like Dream Industrial. Same property NOI growth was less than 3%. They've had to lower their guidance for the year, mainly due to the timing of some lease up of vacancies. So you combine that with a higher than typical debt to EBITDA, higher leverage on its balance sheet, and though that distribution is quite attractive, it comes with a high payout ratio over 100%. So again, not necessarily sustainable over the long term, but if they can lease up some of their vacancies, you can see that payout dip below 100%. So not a name we're focused on today in the fund. We have owned it in the past, but we think there's better opportunities in industrial with higher growth rates.
Okay, good to know. Let's move on then to John, who's in Markham, Ontario, with a question. Hi, John.
Oh, hi. Good afternoon, folks. Just had a question on Allied Properties. There's been quite a drastic drop in the stock from about the $21 level to about $13 most recently, and a lot of talk about the distribution. Just wanted your thoughts on the distribution and whether you'd be a buyer at these levels. Thank you again.
Okay, thank you for the question. So they do office properties, and I know some have been struggling in that sector because of getting people back to work and whether or not people still want to work from home. So a company like Allied Properties, what situation are they in right now?
Well, they're in a tough situation. They have outlined to the market that they're not going to meet their occupancy goals or leverage reduction goals by the end of this year. They're not going to hit them next year. They're perhaps going to hit them in 2027. So that has, where there was some enthusiasm in the stock, where people were excited about return to the office and leasing activity picking up. All that came out of the stock in the past month or two. Sitting here today, though, you're staring at a distribution cut coming. Typically, you do not want to own publicly traded REITs in the face of a potential distribution cut, and we believe one is coming in a few weeks in December. So we think there's another shoe to drop, because that 13% distribution yield is certainly not sustainable, especially now that they have communicated that their earnings are not going to pick up for another couple of years. You layer on to that. The market is skeptical that they're going to be able to sell a building in Vancouver and with those proceeds get paid back on a really large loan from a company called Westbank, $240 million that they are waiting on from them. Plus, the market is skeptical that Westbank's going to be able to, and Allied are going to see their condos in Toronto at the King Toronto development close. And those two capital injections into the REIT will help pay down debt. And so that skepticism in the market is causing an overhang on the stock. So I think we think it's early. Their office portfolio is a high quality one. We are seeing a recovery in the office market. But we think it's early, and we certainly see the track record of what REITs do after they cut their distribution, and will remain on the sidelines until then.
Yeah, so a lot going on for Allied Properties. Okay, let's get to Alan in Montreal with a question. Hi, Alan.
Yeah, hi. Thank you very much for taking my call. I'd like to ask Andrew's opinion on BSR Real Estate Investment. It's a U.S. company. I bought it several years ago on Andrew's recommendation, and I wonder if he still likes it today, or if there's something better I can get into. Thank you.
Thank you for the question. So they do sort of family homes, that kind of thing, family apartments?
Yeah, multifamily apartments in the United States, focus on the U.S. Sunbelt with concentration in Dallas, Austin, Houston, Oklahoma City. We do like the company. They have been navigating a very difficult operating environment. So whereas this is something we've talked about in the past, in the interim, you've seen a lot of new supply hit the U.S. markets. And as a result, the company doesn't have the pricing power that it once had. We think they've done an admirable job of navigating through a tougher operating environment and through this backdrop. And they actually did a very neat transaction earlier in the year where they sold about 30% of its portfolio to another publicly traded company called Avalon Bay. And so sitting here today, it's a company that trades at a nice discount to net asset value, safe distribution yield, and we think it's a little early in the recovery. 2026, you may not see it, but certainly by 2027, we think you'll see the return of positive operating fundamentals for U.S. apartments in the Sunbelt.
Okay, good to know. That was BSR Real Estate Investment Trust. That's all the time we have for your phone calls and your emails, but Andrew will share new top picks. That's coming up next. Welcome back. Time for new picks from Andrew Moffs. We're going to start with Digital Core REIT. This is a play on AI. It's a data center asset company.
It is. It's a very unique entity because it trades on the Singapore Stock Exchange, yet it owns only 11 data centers in key markets globally, concentrated in Northern Virginia, Frankfurt, Silicon Valley, Osaka, Japan, Toronto, and LA. They report in U.S. dollars. They pay their dividend in U.S. dollars. We think this is such a unique opportunity to own high-quality stabilized data centers in power-constrained markets, trading at a 35% discount to net asset value and paying over 7.4% distribution yield. That's really attractive. Every day in the Wall Street Journal or the Globe and Mail, you read an article about everyone trying to get into the data center space. Well, here you can go out and buy the highest quality data centers globally at a 35% discount. this is a unique arbitrage that exists. Why is it happening? Because of one expiry of a tenant in one of their assets in Northern Virginia, which is the best data center market globally. We think there's a great opportunity to increase rents substantially. Singapore investors don't appreciate that. They're only investing for the yield, and they don't understand that the enterprise value is going to go up materially once that lease is signed come next in the next few quarters.
Okay, good to know. We do have to move on to Go Residential REIT, GO-U on the TSX. They do luxury high-rises?
They do. They just went public. This is one of those unique opportunities where you can buy U.S. assets listed on the Toronto Stock Exchange. They own ultra luxury apartments in Manhattan. I've talked a lot about multifamily fundamentals in the United States, which have suffered from new supply. You don't see that in Manhattan. You actually see 1% vacancy rates and compelling rent growth. This company just went public. It has not traded well off the IPO. We've seen this movie before where Canadian investors don't appreciate the quality of what they are owning and buying. It trades at a very wide discount to net asset value. We think it's a very compelling growth story given the mark-to-market opportunity in their rents and a bit of the overhang of the New York mayoral election where there's some confusion of rent controls. This company, the majority of their units are non-rent control units. And so we think there's a lot of upside to this stock. Okay, let's quickly get to your third pick, which is something we talked about before, and that is homes for seniors. Chartwell Retirement is one you like. Yes, I've talked about how great the fundamentals are. You've got over 4% CAGR in the over 80 population over the next couple of decades. You've got less than 1% of stock of new supply. They have market-leading occupancy over 95%, meaning they can push rents over 4%. Their expenses are growing at less than 4%, so margins are improving. They are in a sweet spot that we haven't seen before. Okay. We really like this stock, and they're doing a great job with cap allocation and see a lot of upside. Got it. Andrew, got to leave it there, but thanks for your time, and thank you for joining us today on Market Call. We'll see you back here again tomorrow.